Tonight, we look at three massive corporate titans dominating the global financial landscape. These industry leaders hold immense power over the economy, and their market influence is staggering. First up, Apple. What started in a deep garage with Steve Jobs and Steve Wozniak has evolved into a full-on powerhouse. Driven by its product and services, Apple pulled in a tremendous $451 billion in revenue this past year. With a commanding market cap of $4.4 trillion, they run the largest share buybacks program in corporate history to aggressively reward their investors. Next, we look at the healthcare giant, Johnson & Johnson. Even after undergoing a massive structural change, spinning off its consumer division into a new company called Kenvue, J&J still commands a $550 billion market caps. It expects $100 billion in annual revenue and remains one of the two firms holding a pristine AAA credit rating. Plus, as a true dividend king, J&J has increased its shareholder payout for over 60 consecutive years. Finally, energy power of ExxonMobil dominates the traditional oil and gas sector. From ocean drilling to global fuel sale, they lead the S&P 500 energy sector with a commanding $635 billion market cap. Known for its premier cash distribution, Exxon returned over $37 billion to shareholders last year alone, keeping a 43-year streak of dividend increase alive. Ever wonder if a stock is actually worth its current price market? To find out, investors look for its intrinsic value, which is the inherent worth of company based on its fundamentals and risk profile. There are two main ways to calculate this. First, there is the dividend discount model. This looks at the company strictly from a shareholder perspective, valuing the stock based on the sum of all future dividend payments. But for corporate giants like Apple, Johnson & Johnson, and ExxonMobil, there is a much more robust approach, which is called the discounted cash flow or the DCF model. Instead of just looking at dividend, the DCF model focuses on free cash flow. That's the actual cash company generates after paying all its expenses and the capital. It's look at the business from an owner's perspective. While Apple, J&J, and Exxon all pay steady dividends, relying on dividend alone ignore how these giants actually manage their massive capital and survive economic shift. That's why our upcoming studies use the DCF model to give a complete, accurate look at the raw economic driving this mega corporation. Moving on to Apple. To set the stage, Apple offers an exceptional blend of stability and market-leading performance. It is a business heavily insulated by a massive free cash flow generation, featuring a market relative beta of 1.09. This world-class financial foundation allows Apple to safely absorb macroeconomic volatility while continuously protecting shareholder value through its aggressive share buybacks. If we look at the core assumption card on the right, our 5-year forecast built in a highly reasonable 6% free cash flow growth rate. This pair with a company beta of 1.09, you also notice a highly equity skewed capital structure consisting of a 98.92 equity percentage and 1.08 percentage of debt. Moving to the center card, this heavily equity weighted structure directly influence Apple cost of capital, while the standalone cost of equity sits at 17.49% and the implied cost of debt is 4.48%. Our optimized WACC comes out to 4.97%. We utilize this specific rate to accurately reflect Apple's massive share repurchase distribution model over the traditional dividend metrics. Finally, look at the intrinsic value card on the left, factoring in the conservative of 1.5% terminal growth rate brings our model finding intrinsic value to $296.62 per share dollar. Comparing this to the actual market price of $271.36, Apple is trading at a discount. This leaves investors with a highly attractive expected gain of 9.3%, confirming that Apple remains fundamentally undervalued relative to its pure cash generating power.
So this slide we will be presenting about intrinsic valuation model for the Johnson & Johnson company. So based on our discounted cash flow valuation, we estimated an intrinsic value of $206.37 per share, which is very close to the current market price of $206.95. So this indicates that the stock is fairly valued in the market at the moment. So our model suggested that the potential gain of around 0.28%, meaning that there is a limited upside based on our assumptions. So for the valuation, we projected a 5-year free cash flow growth rate of 5.25%, which was derived using the company's historical free cash flow performance. And we also assume a conservative terminal value growth rate of 2% to reflect the long-term sustainable growth. And looking at the company's cost of capital, we calculated a working average capital of 5.57%, and this was mainly driven by the cost of equity of 5.66% and after-tax cost of debt of 4.36%. The relatively low WACC reflects that J&J's strong financial position and low risk profile. One of the key reasons for this low risk profile is the company's beta of an only 0.26%, which means that its share price tends to fluctuate much less than the overall market. In addition, J&J's capital structure is heavily weighted towards the equity, with approximately like 93.1% equity financing and only 6.1% of debt financing. Overall, I would say that Johnson & Johnson appears to be a stable and financially strong company. While our valuation does not indicate that a significant short-term upside, the stock may still be attractive for investors who are seeking for a steady return, low volatility, and long-term capital preservation. So this slide presents the intrinsic valuation model for ExxonMobil Corporation. So based on our valuation, Exxon has an estimated intrinsic value of 163 per share compared to its current market price of 120 per share. This indicates that the stock may be undervalued and offers a potential upside of approximately 35.83%. So one of the key assumptions in our model is a 13 annual free cash flow growth rate over the next 5 years. Instead of using a historical CAGR, we adopted a management's growth expectation from the annual report because Exxon's cash flow was significantly affected by external events such as the COVID-19 pandemic and the sharp decline in oil price during 2020. So we applied a conservative 2% terminal growth rate to reflect the long-term sustainable growth. And looking at the company's cost of capital, Exxon has a relatively low working average capital of 4.85%, supported by the cost of equity of 5.02% and after-tax cost of debt of just 1.02%. So this low cost of capital increases the present value of the future cash flows and contributes to the higher intrinsic valuation. In terms of risk, Exxon has an exceptionally low beta of 0.15%, suggesting that its stock price is less volatile than the broader market. The company also maintains a strong balance sheet with approximately 95.68% equities financing and 4.32% debt financing, which reflects a conservative capital structure and effective financial management. So overall, from our analysis, we suggest that ExxonMobil offers an attractive investment opportunity. The combination of strong projected cash flow growth and a low cost of capital and significant upside potential makes the company an appealing choice for investors seeking both stability and long-term value.
Thank you, Danish. Now we look at the pro forma financial modeling. As you can see on the first slide, this approach rests on the 3 core pillars. For the first one, forward-looking forecast. Rather than just looking in the rear view mirror at historical data, pro forma models allow us to translate complex accounting figures into a comprehensive forecast of a company's long-term future performance. Second is accounting integrity. To make this model accurate, we have to establish strict principles to dictate how the company's financial will evolve. This means carefully accounting for corporate payout policy and adjusting for real-world economic deviations. And finally, the economic goal of this entire process is reliable valuation. By standardizing our forecasting process, we minimize valuation errors. This gives us a highly reliable, mathematically sound framework to determine a stock through intrinsic value, which tells us whether we should buy, hold, or sell. Let's look at our first valuation. Our first analysis is on Apple Incorporated. For our model, we projected a robust sales growth of 9.34%, which is heavily grounded in their historical performance ratios. When looking at Apple's capital structure, our model assumes the company will not issue any new equity or take on new debt during the forecast period. Because of Apple's massive profitability, cash serves as the balancing figure on the balance sheet, resulting in a steady organic accumulation of cash reserves. To value the firm, we applied a weighted average cost of capital, or WACC, of 4.97%, alongside a terminal long-term growth rate of 1.5%. When we run this cash flow through our model, we arrive at an estimated total equity value of 7.08 trillion. Divided by their outstanding shares, this translates to an intrinsic value of $468.85 per share. Because of Apple's current market is trading at $271.86, our model indicates that the stock is significantly undervalued. From a strategic standpoint, this presents a strong buying opportunity for investors. Next, we shift to the energy sector to look at ExxonMobil, which presents a very different financial picture. Our model forecasts an aggressive sales growth of 15.62% based on historical revenue estimates. However, when we look at the capital structure, again using cash as balancing figure, our projection reveal a significant decrease in Exxon's cash reserve for over the 5 years to support its operation and payouts. For our valuation metrics, we applied a much higher WACC of 20% paired with an optimistic terminal growth rate of 10%. Despite the aggressive growth estimate, the heavy operational expenses and high cost of capital severely constrain the firm's valuation. Our model calculates an intrinsic value of just $32.86 per share. Given that ExxonMobil is currently trading at the price of $120.34, the stock appears to be heavily overvalued. Therefore, our strategic outlook suggests a clear selling opportunity. Finally, we analyzed the consumer staple and healthcare giant Johnson & Johnson. Our projection here show a highly stable financial trajectory driven by steady sustained sales growth of 6.05%. Similar to Apple, we assume no new equity or debt issuance. As a result, the model shows massive organic cash accumulation, growing from $20.1 billion in 2025 to staggering $185.5 billion by 2030. For our valuation, we utilized a stabilized WACC of 5.50% and a conservative terminal long-term growth rate of 2%. The steady, long-risk cash generation yields an estimated total equity value of $2.29 trillion. This calculates to an impressive intrinsic value of $736.02 per share. When we compare this intrinsic value against Johnson & Johnson's current trading price of $206.95, it is clear that the stock is significantly undervalued. Like Apple, this indicates a highly favorable buying opportunity with strong potential for long-term price appreciation. Now I will pass to my teammate Putra. Thank you.
Rahim. Assalamualaikum. My name is Putra and I'm going to be presenting the pro forma financial statement model with debt and equity ratio set earlier by us based on our own analysis. Now for Apple, we assume a target debt to equity ratio of 0.8, reflecting its ability to comfortably support moderate leverage due to its strong and predictable cash flow. Now, over the forecast period, its earnings increased from 73,000 to 159,000, while the property, plant and equipment (PPE) only increases slightly from 49,000 to 56,000. At the same time, the cash balances accumulate significantly, which shows that there is a strong internal cash generation. Now, overall, this modest growth in fixed asset suggests that Apple is not heavily constrained by capex needs, while the strong cash inflows provide enough liquidity in order to support the expansion. Now let's look at Johnson & Johnson, or even better known for us as JMJ, one of the biggest healthcare leader in the world. Now, for this company, we assume a target debt to equity ratio of 0.5, reflecting its ability to support moderate leverage particularly due to its strong and predictable cash flow. Now, these cash flows are driven by its diversified healthcare portfolio, particularly across the pharmaceuticals, the medical devices, and especially the consumer health products, where demands for this kind of things remain inelastic across economic cycles. Now, over the forecast period, the retained earnings has increased from 168,000 to 332,000, while the debt has risen from 39,000 to 122,000. Now, at the same time, the net fixed asset increased only modestly from 23,000 to 27,000, which reflect the company's relatively low capital intensity in its operations. So overall, the gradual, if you were to analyze it back, the gradual increase in the fixed assets combined with its strong internal cash generation indicates that Johnson & Johnson J&J is not really constrained by heavy capital expenditure needs, and the cash flow that they have, the stable cash flow, give them more than enough financial flexibility. Now let's look at the last company, which is the ExxonMobil. Now for this company, we assume a target debt to equity ratio of 0.2, which reflects a very conservative capital structure, but it is consistent, especially because of its exposure to commodity price volatility. Now, their cash flow are driven by integrated operations across the energy value chain and also supported by long-term contracts. So it's going to give them a quite stable cash flow and earnings. Now, over the forecast periods, from what we have examined and from what we have projected, the retained earnings is going to increase from 482 to 551,000, while the debt will rise from 34,000 to 150,000. Now, at the same time, the net fixed asset increased significantly from 299,000 to 518,000, which reflect a very heavy capital investment, particularly in the long cycle energy projects, the upstream development. Now, overall, what we can say is that the strong increase in the fixed asset combined with the rising capital expenditure requirements show that yes, ExxonMobil remains highly capital intensive, and this outcome also shows that under low leverage, which is 0.2, Exxon's growth will primarily be financed by equity, which will limit their financial flexibility in the later forecast years, as more and more funds will be allocated to capital investment. And thank you, that's all from my part.
To conclude, based on the pro forma analysis, Apple generated an intrinsic value of $468.85 per share, and Johnson & Johnson generated an intrinsic value of $736.02 per share, both substantially higher than their market prices. In contrast, ExxonMobil produced an intrinsic value of only $32.86 per share, significantly below its market price. After incorporating the target debt-to-equity ratio analysis, we concluded that Apple and Johnson & Johnson are capable of sustaining their projected growth while maintaining healthy capital structures. Therefore, our final recommendations are strong buy for Apple, strong buy for Johnson & Johnson, and sell for ExxonMobil. Our recommendations are generally consistent with analyst expectations for Apple and Johnson & Johnson, although our valuation estimates are higher due to differences in assumptions and forecasting methods. For ExxonMobil, our recommendation differs from analyst consensus because our pro forma model indicates significant overvaluation and lower financial flexibility. Finally, we acknowledge that our valuation models are highly sensitive to assumptions regarding growth rates and the weighted average cost of capital. Future improvements could include broader sensitivity analysis, scenario testing, and the incorporation of additional qualitative and macroeconomic factors to improve forecasting accuracy. That is all from us. Thank you very much.